All right, welcome back to the weekly rebalance, episode number 6. I think we're number 6 right now, right? Or is it 5? I think it's
Yep, it's number 6.
number 6, 6 weeks in a row.
Go.
Yep. Um, cool. Thanks, Nick. I think, this week is interesting. We have a couple particular, very specific topics that I think are pretty relevant to go through. We did some extra research this week because I think, what's interesting to me as I follow, as I just field questions from advisors, which are ultimately coming from retail investors, this trade, the continued trade and the love for these AI names is it's interesting how much they love it. They love it. The retail investors love it. And I feel like sometimes when I go through the conversations, a lot of the advisors love it too. And I hate to sound bearish on them. And I don't want to be bear. I don't even think I am bearish on them. I'm just trying to be reasonable on them. So, anyways, I wanted to discuss that a little bit, as well as the other hot topic, or one of the other hot topics out there, which was the gold, silver, precious metal conversation. So we're we're planning on getting we're planning on getting into both of those things this week in a little bit more detail than normal. So I'm kind of excited about it. I've been looking forward to this all day.
Yeah, absolutely. Um, Definitely been looking forward to this one a little bit more than the others, just given the research we got to do leading up to it. Kind of like you said, this was a good portion of this was prompted by probably our last call yesterday, right? With one of the advisors we meet with. We just get a lot of good questions from advisors and good research material. So,
Yeah. It's funny to me how many times we have a conversation. What feels like happens to me a lot is we'll end up, for whatever reason, no particular request, right? But we start we dive into a particular topic, whatever the topic is, AI, gold, whatever. And then we end up like that day or the next day, we end up um, using it.
yeah,
Um,
getting asked about it.
yeah, you end up getting asked about it, and it's it's funny how timely that is sometimes. So it was so funny. We were on a call yesterday with an advisor, and we were literally doing this research, and then it came up like, hey, what are your thoughts on AI? What are your thoughts on gold? It's like, yeah, well, that's funny you said that.
Yep.
Um, literally, that's on the other screen right now. So. Anyways, yeah, I was so for the AI stuff. You want to start with that
Yeah, let's do it.
conversation? Okay, cool. The big questions that I had was just this big boom. And to me, I'm excited about the AI trade. I'm excited. I mean, I use it. We use it at Revisor. We love using Copilot, ChatGPT. I particularly love Copilot. This meeting's transcribed in with Copilot, recorded with Copilot. All it's wonderful. But companies like, I mean, the big ones, NVIDIA, Oracle, Intel, Microsoft, AMD, you name Meta, they have um, they've just their market caps have surged. And the two questions that I kind of wanted to answer were, has the expansion of the market cap in those leaders, has it gone too far? And then, okay, what does that mean? And are we forgetting about some of the downstream beneficiaries that will maybe experience this later on? Is there a broadening out effect that will come later on? And who are the beneficiaries of that, coming that coming trade in the future, the spend, because the spend on AI is, or the planned spend on AI is absurd. It sounds absurd sometimes, But if that's true, it should trickle down to the rest of the economy in the future. That's my thought. I don't know what you think about that, Nick.
Yeah, I mean, absolutely, especially as we see more adoption within the space. We're at the early stages of this. Even companies like us we're starting to use AI, but I think we're still kind of beginning to see the effects of the increasing productivity that we're expecting to see from AI, that sort of thing. So seeing that come through to more traditional companies that are maybe able to operate more efficiently. Additionally, just companies that are, you know, not the chip manufacturers, but other supporting industries that help make all of this work. Utility companies, like we're going to get into later. We haven't quite seen that broadening out yet. So
Right.
I think there's a lot that still remains to be seen with this, and we're kind of in the first phase.
Yes. Yeah, exactly. It's crazy. Well, just to highlight just how um, crazy, and I'm not going to call it crazy because again, I don't want to sound too bearish on these companies and just trying to put some perspective on things. I have some quiz questions for you, Nick.
Oh boy.
I hope you didn't cheat on this. If you did and you know all the answers, well, you're really smart, so maybe you just know.
No,
But I have some.
I did not get to cheat,
Uh,
unfortunately. I was
okay,
crunch
I have
time
some.
before.
Okay, I have some quiz questions. I have some quiz questions. I just want to see
All right.
where you fall
I'll
in
have to
this.
come up with a quiz for you later.
Yes. Okay. Um, the first question. Okay. The let's compare. Well, I'm just going to use NVIDIA as the example because it's the top one. It's
Okay.
the focus, right? At least in publicly traded companies. So let's compare first in NVIDIA to GDP of countries. Okay.
Okay.
Can you tell me what two countries have a compared to NVIDIA's market cap? Okay, market cap of NVIDIA. What two countries have a market cap or have a GDP that's greater than the market cap of NVIDIA?
Okay. Well, I
There's
guess you got
only two.
US,
Yep.
and then I mean maybe China.
Yep.
I'll guess China.
US and China. Yeah, so that's right. So there are two countries that have a GDP that's greater than the market cap of NVIDIA. There are two countries that are really, really close that have within they're within a couple they're within a slingshot throw of NVIDIA, but they're or equivalent. Um, there are two major developed countries that their
Okay.
GDP is very close to NVIDIA's market cap.
Um, Japan. I mean, uh, I Britain.
Japan's one of them. Yep. Yeah, that's right.
or,
So there are
or
actually several. There are two that are really, really close.
maybe Germany.
Yep.
Okay.
That's the other one. So Germany, Japan. Here, I'll pull up the whole thing on my screen here so you can see really quick. Then I'll pull it back for the next quiz question. So this is the GDP on the left of each of the countries, and then the comparison to NVIDIA. So Germany is about equivalent to NVIDIA's $4.5 trillion market cap. Japan is slightly less. India is an interesting one for me because you think about the growth rate in India, which is expected to be very high, in the growth rate of NVIDIA, which is expected to be very high, but the entire GDP of India is less than NVIDIA's market cap.
That's
But then
crazy.
the UK and France, um, less than a bit. And then look at these, options these ones down here with Canada and Russia, where their GDP is half that of NVIDIA's market cap.
Wow,
Kind of crazy.
that is crazy. I think it's really funny too, and this is just kind of a side note on this is just how large the GDP of China is, and it's still considered an emerging country.
Yeah, that doesn't quite make sense to me.
Sometimes, but yeah, that's just an interesting little.
Yeah. Okay, so I got another next quiz question.
Okay.
Comparing, I got lots of quiz questions for you
Oh
today.
God. All right. I'm ready.
All right, so next I wanted to compare NVIDIA's um, market cap. Okay, again, 4.7 trillion dollars. That's the market cap as of October of NVIDIA. And I wanted to compare not just the GDP, because that's not a great comparison. GDP is more like revenue, you know. Um, so wanted to compare the total market cap of the stock market in countries, different countries, to that of NVIDIA's market cap, right?
Yep.
Okay. So again, NVIDIA's market cap 4.5 trillion. There are three countries that have a market cap that is greater, total stock market, large cap through small cap in each of these countries that are greater than NVIDIA's total market cap. There are three of them. Can you guess the three?
Yeah. So we got U.S.
Yep.
Gosh, I feel like I have a little bit of insight into this because we were talking about it this weekend.
Yep.
Germany's less. I remember us talking about that, right?
Germany
Germany's
is less.
Germany's
Yes.
slightly less. Um, I don't know, Japan and the UK.
So it's China and Japan.
China and Japan.
Yep. China and Japan. So here, I'll share my screen again. So stock market of the US, $67 trillion, 15 times that of NVIDIA. China, only 2.4 times that of NVIDIA, the whole Chinese stock market. Japan, 1.4 times that of NVIDIA's market cap. And India, this is an interesting one. India is almost equivalent, 4.4 trillion. Um, Almost equivalent to NVIDIA's market cap. That's the entire Indian stock market.
That's crazy.
Crazy. UK smaller, Canada smaller, France smaller, Germany, Switzerland, Taiwan, Saudi Arabia, Australia, all these major developed countries, less market cap in their entire stock market than NVIDIA.
It's crazy. I probably should have got China being, but oh well. Oh well.
You do pretty good. All right, I got one more quiz question for you.
All right.
Okay. Okay. So the next one is let's see, how do I want to phrase this? Um, the I have let's see, I'm gonna ask it this. Would you rather I want to compare I'm trying to do a comparison. I want to illustrate the comparison of NVIDIA's revenue,
Okay.
okay, which I think was $165 billion the last like the trailing 12 months.
Yeah.
Um, So the compare the let's I want to either compare GDP or total revenue from the whole stock market for countries. Again, we're comparing NVIDIA to countries here.
Okay.
The entire country. So do you want to do we'll do just one of these. GDP, you want to do the comparison of GDP or the total revenue of the stock market from the countries?
Sure.
Which
Let's
which
do
one?
let's do um let's do total revenue.
Okay, total revenue. Okay. So let's see how to ask this. So again, NVIDIA's revenue on I did this as of their last full year filing, so it's 130 billion. Was their I think their fiscal year end is January. Um, it kind of so we're looking at the last full calendar year. The um countries, the stock markets, just the stock markets, like the US stock market or the European stock market or whatever, um, how many, what percent of the um, revenue for the total US stock market comes from NVIDIA. So NVIDIA's revenue divided by the revenue in
The entire stock market.
the total stock market. So let's just US first. What do you think it is?
Mm, Sure, it's less than the market cap percent of the S&P.
Yep.
I don't know, 5%.
0.69%.
Wow. Wow.
Okay, so if we had to compare revenue as a percent of the total market revenue for, let's just do the whole Canadian stock market, which remember, it was significantly larger than in terms of market cap.
Yeah.
How much do you think that comparison is? NVIDIA's revenue is if you were to divide that by the, total revenue for the Canadian stock market.
So we were 0.69% on the US market.
Yeah.
Uh, Probably somewhere around my first guess, maybe 6%.
That's amazing. 5.9%.
I'll
Yep.
take it. That's my
There
big
you
win.
go.
That's my big win.
That's crazy. That's a good guess. Uh, or you're just smart. Yep. Isn't that
No,
crazy?
that's a good guess.
Here's the full chart. This is the comparison I did. So look at that.
Wow.
These stock markets are generating multiples of NVIDIA's revenue. Look at this. So you can, I guess the illustration on all this, right? These are fun numbers to play with and everything. But basically, I guess the point was that there's immense growth expectations put on NVIDIA and a huge multiple put on that growth in their revenue, in their earnings. And it's just, again, when you make those comparisons, it's like, whoa, what
That's
what
pretty
is
crazy.
happening?
Pretty crazy for sure.
Yeah. Well, I don't know. What do you, I don't know. So when you're talking to clients, advisors, whoever, I mean, do you think that do you think that many people know those comparisons?
Um, yeah, I mean, certain advisors, they're definitely aware of, concentration of the entire market cap within the US, just how large NVIDIA is as part of that. But when we get into the specific, revenue metrics, um, pieces like that, I think it would come as a surprise to a lot of the people that we work with. In particular, the end investor would probably be surprised to learn that. And I mean, we talk about this a good amount, and we've talked about this in the past on this podcast, but just the end investor, I think would be largely surprised at the percentage of their portfolio if they just buy SPY.
Hmm.
This, coming from NVIDIA.
Yeah.
So yeah, I think a lot of people would be surprised by those metrics. I know. I mean, I'm in the space day to day, and I hadn't done that specific research, and I'm surprised to see revenue, the share of revenue within the U.S. being so small for NVIDIA. I would have expected to be
Yeah.
larger than that, just given how much we talk about it, and its percentage of
Yeah.
the market cap. It's pretty crazy.
Yeah. I mean, it's interesting. Like you know, Canada's total stock market is, 50% the market value, the value of NVIDIA, and yet it generates, Canada's GDP is 13 times that of NVIDIA, right?
Yeah,
It's NVIDIA would only make up 5.6% of the total revenue generated by the Canadian stock market. It's again, I say these things all with this caveat of I don't hate NVIDIA. I don't have a problem with that. It's just trying to bring some light to the fact that there's some real lofty valuations that very well could be accurate, but there's definitely some risk there. And I think that again, it's like a lot of the downstream effects have been potentially forgotten. Um, and a lot of these deals that are going on, they're like there was the deal last week was OpenAI and NVIDIA, right? The deals are circular oftentimes. They're agree NVIDIA is selling their chips to OpenAI, and OpenAI is taking a stake in NVIDIA or sending money back to NVIDIA. It just does the like, okay, how is that going to trickle down to the rest of the economy? I think it will, and that's where I think some of the more interesting things or the interesting investments might take place over the coming 5 to 10 years. I think you could see, lots of infrastructure beneficiaries, data center REITs, um, utilities and power companies, cooling and HVAC companies. I think there's a lot of potential there in like the next phase where we need a ton of infrastructure to support the AI boom, and data centers, utility, power companies, cooling, HVAC companies, all of those companies are going to be, need major investments, have revenue flow down to them if the expansion keeps coming. And then beyond that, you have, I mean, all these other sectors that are going to be beneficiaries, like you just mentioned, Nick, like we use AI here at Revisor, right? I think a lot of companies are starting to use AI. The company that I was at today, I was at a meeting today. The last meeting of their day was they're implementing Copilot for everybody. And again, that doesn't they that those companies aren't necessarily monetizing that right away. Like NVIDIA is monetizing the need for their chips that are being sold everywhere right away. And a company like ours, we're not monetizing it yet. We're seeing efficiency gains, right? But even that, they're small and they're going to grow, right? And you don't necessarily see it for a publicly traded company. You don't necessarily see that expansion just in day one or in year one. You see it over time, this trend of wow, we're much more efficient, much more productive. And then I think you start to see that, and I think you'll start to see the use of like in healthcare, in fintech, transportation, logistics, autonomous vehicles, all these things that are way more downstream that are years down the road that are not necessarily experiencing the growth rate, the expansion in market cap that like NVIDIA, Oracle, et cetera, are having. They're likely to get that in the future, and that's there's some really interesting investment opportunities in that space, and I think it's something to pay close attention to, and just my expectation would just be a general broadening out. Uh, I think that it's not normal to have this type of concentration forever. And again, that's not a bearishness on the AI trade. If anything, long term, it's a bullishness on the AI trade. That this is going to trickle down to the rest of the economy. It's just going to not happen overnight.
Yeah. Yeah, absolutely. I think there's still plenty of people that are going to benefit from this, or plenty
Yeah,
of companies in a big way.
definitely. So, anyways, what are any other thoughts on that, Nick? Or I talked a lot there, so sorry, I didn't mean to
No,
take over the conversation.
no, I appreciate it. I've learned a lot in that segment. I think the only thing that I wanted to add, and this is the thing that I keep on coming back to with NVIDIA that helps, um, you know, for the lack of a better term, justify the large multiple that they're trading at right now and just the market cap would be their PEG ratio or their PEG ratio, however you want to say it, their price to earnings over growth ratio. Still well within, reasonable metrics compared to their competitors and just other companies as a whole. Um,
Yeah,
that's the big, if we take a look at price to earnings, sure, that multiple is very extended. Maybe not the most extended in the entire market. They're not a Palantir, but um, when you bring in that growth rate to start to justify that PE in a way, it starts to look more and more reasonable. So that would
yeah,
be the only point I have on I guess on the other side. Not that you're down on NVIDIA by any means, but that's the only ratio that I keep coming back to that kind of makes it seem. I don't want
reasonable.
to say reasonable, but I guess yeah, reasonable.
Yeah.
But
Well,
you know what I mean.
I do know what you mean. Yeah.
Yeah,
Well, that's why again, I always want to caveat these conversations when it's talking to an individual investor and advisor that I'm not down on NVIDIA. I don't think you should sell it or short it or do something crazy like that.
Yeah.
Just remembering that there's other parts of the market um, that are out there that could see these benefits long stream. Again, I have no qualms with any of these companies. I own them myself, and they're in our portfolios. It just just making sure that there's some logic out there, especially for the investors that are really highly concentrated in them, making sure that they understand what exactly that means. So
Yeah, it just comes up in conversation so much. We kind of have to always talk about it, and we're always getting asked what we think about NVIDIA. So I don't know. It's kind of a tricky line to walk because on the one hand, we don't hate it. We don't think it's going to do horribly. But on the other hand, you know, people already have a lot of exposure to it if they have exposure to something like a SPY fund or pretty much anything that's market cap weighted. And, maybe the advisor's asking if we should throw additional money into that strategy or additional money into one of those companies. And so it's a conversation that we have a lot. So
yeah.
always at the top of mind.
Well, and again, coming back to the name of our podcast, right? The weekly rebalance. The
Yeah.
weekly rebalance. I think it's my advice to is if you can, right, rebalance. This is a good time to rebalance, diversify, rebalance, not get rid of those names, not get rid of those positions, but just remember there are other parts of the market, rebalance, take some of your profits from those particular positions, diversify into other names in the US market and the international markets and just and diversify a little bit. This is a perfect time to do that. And yes, it's a risk control. But that is a reasonable thing to do. Especially at a point like this when valuations are definitely we've experienced wonderful expansion in those valuations. So great time to again not eliminate them, but rebalance and get to a place that you're comfortable with.
Yeah, absolutely.
So, anyways, that's what I had on that. Now on the flip side, I'm waiting for my questions.
Okay, all right, all right. I'm gonna come up with some here. I've actually got some decent trivia here. I think I've been putting this together in my head while talking through these other things. So I'm gonna come up with some good questions. Mine are not gonna be. I think some of these are gonna be a little bit more like true trivia as opposed to market knowledge questions. So maybe we'll
Sounds
see.
good.
We'll
I like
see.
maybe this will be a new little theme for us going forward, is trying to quiz each other.
Try to trick the other person into saying something silly.
It's like do you get those I don't know that I get them anymore, but when I was going through the studying for the CFA charter exams, you get the
I get one
CFA
every day.
question of the day.
Yep, I get one every morning.
Yep.
Um, all right.
Your focus research this week was on gold, right? Gold and silver.
That is correct. Yep. We were taking a look at gold and silver, and I know we've talked about gold a decent amount recently, but specifically we had a question come up about the gold silver ratio, which is an interesting topic, and we did some digging into it and just thought it would be interesting conversation for the podcast, and went on ahead and did a little bit of a deeper dive on it. Just since that's a different facet of that topic. And I think one of the questions that maybe we didn't address when we were talking about how much we like gold was, why don't you like silver? Why don't we put some money in silver? That sort of thing. So I thought that this would be a good way of addressing that. Um, so up here, we've got a graph of the return on gold versus the gold on silver, or the return on silver over the past 30 years, or a little bit more than 30 years. And you can see that they return somewhat similarly. Silver seems a little bit more volatile. At the end of the day, hasn't returned the same amount as gold over the period that we're looking at, but there's periods of time where silver has been outperforming. There's been periods of time like now where gold is outperforming. So gold's a little bit more stable, silver a little bit more volatile. And that kind of speaks to the relationship that we would expect to see with these two precious metals, because while they're both in the sector, or they're both in the category of commodities and precious metals, they behave differently because they're used differently in a number of ways. So we can get into that in a minute. But before we get into that, because I need to come up with some trivia questions here. So the gold to silver ratio, and for those tuning in, if you haven't heard of the gold to silver ratio, it's just how many ounces of silver it takes to buy an ounce of gold. And so over time, you can look at that relationship and you can use it to see if gold is relatively expensive compared to silver. And you can use that to make bets. Typically, people are using it to short one metal and buy the other. You can also use it just to see if one is more expensive than the other, if you're interested in entering a position, that sort of thing. But that's what we're talking about here. Anyways, this is a metric that's become more volatile over time because it used to be set by central banks or just governments as a whole. And actually, I think it's the longest running statistic that we have for financial markets.
Interesting. Really?
Yes. Take a guess of here. I'm going to do a two-part question on this one, if that's allowed.
That's allowed.
Okay.
We'll allow it.
What is the first data point that you think we have for the gold to silver ratio?
So the first, the basically, how far back does that?
How far back, or like what era?
Gold to silver ratio. I'm gonna guess 1896.
Okay. All right. You got to go way back, further.
Further?
The Roman Empire.
No way. Really?
Yep.
We have
Yep.
data. We have actual data back that far.
Well, yeah, because they set the ratio. So, you turn in this much in silver, you get this much in gold back. So that was something they set up. There probably is some obscure reference before that somebody knows about, but from what I did, the little surface reading that I did, I was shocked by that too. It was really interesting.
Yeah.
Can
Wow.
you take a guess as to how many ounces of silver it would take you to get an ounce of gold back in the age of the Roman Empire?
Ooh, okay. How many ounces of silver?
Per ounce of gold.
Hmm. I'm gonna guess it would take, so 1 ounce of gold
Yep.
is gonna take 25 ounces of silver.
It's not a bad guess, actually. It was 12 to 1. It was 12 to 1.
12 to, okay. It's
But
higher
it's
than that
not,
today, is it not?
it
Or
is
is
higher
that?
than that today.
Okay. We're
It's much
getting
higher.
there.
It's much higher than that today. So I've got some other data points throughout history because I found that really interesting and wanted to dig into it more. So in medieval Europe, that ratio went down to 9.4 to 1.
Okay.
And then was set in 1792 by the US at 15 to 1. So it
15
stayed
to 1.
relatively
Okay.
constant over, 1,000 years. So really interesting stuff. Now that being said,
So from the Roman Empire to in 1792, when the
yep,
US set the ratio at 15 to 1, it only expanded by
just a
the
little.
three,
Yep,
basically.
yep, by I guess
3 ounces.
25%. Yeah.
Okay, wow. Okay. Sorry, continue. That's
Isn't
interesting.
that crazy? I mean, I guess
Yeah.
you would think you discover new deposits of each metal, that sort of thing, that could throw it off. But
Yeah.
in
But
circulation, I guess you would expect, especially if a government is setting it, stay
yeah.
relatively constant.
Well, in your pre-central banks.
Yep. Yep. Exactly. And we'll get into that in a second.
Okay.
Uh, so anyways, over time broke away from that. There wasn't a set standard by the US or a lot of central governments where they were going to set, you're going to get this many ounces of gold for this much of silver, that sort of thing. So that went away and it became kind of a free floating metric that was determined by the market.
Okay.
So in 1939, the ratio was 98 to 1.
Wow. Okay, 98 to 1, 1939. After all the spending in
Yeah.
after the crash of 29.
And there was a lot of silver that was discovered too in like the 1800s within the Americas, and I think even before that there was a lot of silver that was discovered, not as much gold.
Okay.
So that's partially influencing that. And then in the
And
1970s, when we broke away from the gold standard and a lot of this became more of a free floating market, we went back up to that 97.5 to 1 ratio, similar to that we saw in 1939. So
wow.
uh, it's been much more volatile since the Roman Empire days.
Yeah.
So we'll take a look at that here in a minute. We took a look at the overall returns here of the two commodities over the past 30 years, which seems like a really short time horizon now.
Yeah, when you're talking about going back to the Roman Empire.
Yeah, yeah, puts things in perspective. So this is a chart we've seen before. This is the price of gold relative to, well, not relative to, but we also have charted the upper limit of the Fed funds rate here.
Okay.
So you can see after cutting cycles, typically gold does pretty well, and during cutting cycles also does. So that was part of our thesis for adding gold to one of our portfolios, liking gold, that sort of thing. We talked about that a little bit more in one of our previous podcasts, so don't have to dive into that too much here. And here's a similar chart that we have for silver. So this is the price of silver, and we have that same federal funds rate upper limit charted on this graph as well. And so what we start to see here, silver tends to perform a little bit better after the cutting cycle is over in this period, and particularly over the time period that we're observing here. Over the past 30 years, this time period between 2010 and 2015 was a great time for silver. But it seems like once the Fed is done cutting, silver has a good amount of performance. And I think that kind of speaks to the nature of the difference between silver and gold. Silver is used in a lot of electronics. Gold is also used, but not in the same amounts. There's not really a great replacement for silver in those electronic devices. And so it's used a lot in production. And that makes silver a little bit more cyclical than gold
Yeah.
in many respects. So what we see is, when the Fed's typically cutting, not necessarily right now, but when the Fed's typically cutting, they're cutting in a recession. So they're trying to, get growth back up. And then in these periods where the Fed's not cutting, ostensibly the market's doing well. They don't feel like they need to intervene. Um, sometimes we get hikes, counter-cyclical hikes, where they're trying to slow down growth a little bit, put a little bit of a damper on inflation, that sort of thing. But by and large, when we see this line go flat, that means the economy is doing relatively well. The Fed doesn't feel like it needs to intervene. So
Right.
You kind of see that cyclical nature of silver show up in this chart here. Now, there's some interesting stuff going on here between 2010 and 2016 with QE, and we don't even have to get into that. But the Fed was doing stuff, but we don't really have to get
Right.
into that for the sake of this presentation. Um,
That's interesting. Yeah, that makes sense. So the silver tends to do well because it's used instead of just as a store of value, it's used actually in the production of a lot of goods,
yes.
less than that of gold. Gold oftentimes, I mean, when a lot of people think of investing in gold, they're thinking of store of value, like or jewelry. And oftentimes jewelry is thought of as a store of value, like gold watches, gold, necklaces, whatnot. Like you can go
Yeah.
give that old gold necklace back or that gold watch back, and it's appreciated or depreciated since you bought it. That is more how I think of gold, and I think how most people think of gold. And that's basically what you're saying here is that so when people think money is getting less valuable, that store of value, gold, is more valuable to them. And then when that's not the case, when things are going well and production is underway, the economy's doing great, the Fed is not intervening and having to adjust policy to accommodate, then that's when production is fine, is ramping up, is high, and that's where silver, the demand for silver goes up.
Absolutely. Absolutely. And there's a lot of interesting stuff going on here, particularly, the silver market is a good bit smaller than the gold market. I think it's like 8 times smaller, that sort of thing. So demand can really move things around a lot. So a good example, recently silver has outperformed gold this year by a decent amount. I think silver's up like 70%, gold's up somewhere around 50%. That's kind of outdated. That's a little bit of a ballpark, but silver overall has performed better than gold this year. And a lot of that seems to be from um, speculation around tariffs. So when those tariffs were announced, people were just loading up ships. They were loading up airplanes full of silver. They were also doing this with gold, but not as much. Um, they were just loading these ships up and getting silver over into the U.S. Um, to beat the tariffs.
Yeah.
So that they would have stockpiles of silver to produce with, make solar panels, chips, electronic devices, that sort of thing. So a lot of silver got brought into the U.S. There was a lot of demand. It was great for the silver market. So silver's done well this year. And a lot of that, I think, is driven by production expectations and tariffs.
Makes sense.
So that was an interesting piece. Now there's some interesting stuff that also comes up with liquidity in the markets. A lot of that silver coming over the U.S. has made liquidity a little bit tricky for the U.K. Precious metal market. People demanding physical settlement, that sort of thing. So who knows? Maybe silver ends up going back over there at some point when people go to arbitrage that. But just goes to show silver is just, I think it's a little bit more tied, or it's definitely more tied to production cycles, that sort of thing.
Yeah.
Gold. So that brings us to the gold silver ratio. So here we've got the price of gold charted on top, and then we've got the price of silver down here on the bottom. And then this is the gold to silver ratio. So this is the gold price in US dollars divided by the silver price in US dollars per ounce. Now this is a little bit out of date because we've only got data as of the end of, I think it's, no, it's at the end of August, I think. The end of August, it was at 88.07, I believe, and I could confirm that in a minute. It's either end of August or end of September, but gold has obviously kept on moving and moved in a big way.
Yeah.
So the current ratio, when I did it earlier today, and it could have moved, was 81.72. So 81.72 ounces of silver per ounce of gold. And that's with the gold price at $4,156.90 per ounce, and the silver price at $50.87 per ounce. So we've actually seen that gold silver ratio come down since this chart ended. So that's an interesting thing to note. Now, a lot of movement did occur in the silver market on Friday after Trump announced, 100% tariffs on China, or increased those tariffs again. So kind of seeing that relationship play out again there. I think the really interesting thing beyond, we've got the average for this relationship over time. The average is 67.61 over the past 30 years. So we're at elevated levels. We're not at the all-time high, which was right after 2020. Makes sense, just given all the volatility. A lot of demand for gold then. And the low was 34.52 sometime in 2012. So some interesting little data there. We're at elevated levels, and this is kind of prompting the advisor that we were on the phone with yesterday was asking, do you guys like silver more, given the gold silver ratio is very high right now? And it's definitely at higher levels. The reason why we prefer gold right now relates to the Fed cutting cycle. And I'm actually going to pull this up in Y charts so that I can kind of move this slider along, because there's an interesting relationship that we see kind of take place here when we can interact with the chart a little bit more. All right. Let's take a look here. Okay, so this is that same chart that I was showing you on that slideshow. We've got Fed funds rate, upper limit, gold price, silver price, and then this is the ratio, the gold to silver ratio here.
Mm-hmm.
And over time, what you notice is that the gold to silver ratio peaks pretty much at the bottom of the cutting cycle, very consistently, at least over the past 30 years. So this period is interesting here because, we had long periods where it stayed similar, and then we got cuts. But anyways, especially, let's take a really pronounced one. So here, all right, Fed funds rate bottomed out in July, or let's see here, this charts, this reading up here is confusing me. June 2003. So this bottomed out June 2003, and you can see that we have a spike, or the peak, for a relatively long period of time, and the gold to silver ratio occurs at that point.
Yeah.
So gold appreciates relative to silver during the cutting cycle, and then after the cutting cycle is over, that's when silver tends to creep up in value, at least relative to gold. Similar story here. Bottom of the cutting cycle. Bottom of the cutting cycle, December 2008. Gold to silver ratio peaks, and it's almost right on the money.
Yep.
Similar story here in 2020. Cutting cycle ends, and we're just before the peak in the gold to silver ratio.
Yeah.
So this is one of the reasons why we favor gold right now. We're still in the middle of a cutting cycle. That's pretty generally agreed upon right now. And so we think that gold is going to outperform silver until we reach the bottom of that, just given this historical trend that we've seen. And then on top of that, just thinking about the behavior of gold in general. Central banks buy gold, and actually a lot of central banks have been loading up on gold recently to diversify against inflation, which I think is kind of funny when you think about a central bank diversifying against inflation. Just a little bit silly. Not necessarily silly, but like maybe you should fix that instead.
So you should fix the inflation.
Diversify. No. Anyways, in all seriousness, they buy gold, and it's an acceptable form of reserve from the IMF. So there's a lot of demand from central banks to buy gold. There's not that same demand for silver. IMF doesn't recognize it as a reserve. I think the only central bank that's been loading up on silver, at least in notable amounts, is Russia. So just there's not that central bank demand. So it's not as correlated with inflation. It's silver, that is, not as correlated with inflation. And typically a little bit more related to, production, just traditional supply demand functions, that sort of thing, within the production market. So we've had a lot of upward pressure on the price of silver recently, with a lot of demand coming from, let's beat the tariffs, let's get it into the US, that sort of thing. And we expect inflation to be, at least above the target. The Fed doesn't expect it to be in the 2% range until 2028 at best. We're cutting rates in an inflationary period. We like gold right now, and that's kind of the fundamental story on top of this historical relationship that we've seen here. And that's why we favor gold over silver. Now, what you'll notice is gold still performs very well when you see this gold to silver ratio drop. It's just silver is appreciating relatively more. So you would rather be in the one that's going up higher. But really interesting relationship that we noticed there. I'm really shocked by how exact this is. Usually with these sort of relationships, you see a lag of some sort, but it's almost right on the money. And there's just a lot of interesting stuff.
Yeah, it's super interesting. Yeah, thanks for doing that, Nick. I didn't know some of that. First of all, those trivia questions were great. I love.
I've got more. I've got another one for you.
All right, let's hear it.
Well, I don't want to interrupt your chain of thought. We'll come back to it.
That's okay. I was just that was super interesting. Just the history behind some of that was really, really interesting. I think, previously my inclination was that in a cutting cycle, you're going to want the gold as a store of value, the hedge of inflation, and just kind of knowing that that's typically where you go in periods like this, but the detailed data behind that, and especially how precise that relationship is, was really interesting. So yeah, thanks.
Absolutely.
Thanks, Nick. I now I want to know the other trivia question too.
Okay, perfect. Yeah. All right. So in 1980, there was a
Yep.
famous scandal where the Hunt brothers tried to corner the silver market and
Okay.
shot silver prices way up. Here, I'll pull up the chart. This is actually really funny because I was looking at the price of silver and we just breached the all-time high that we hit on silver in like 1980, not long ago.
Yeah.
Because these guys tried to corner the market. So it's pretty crazy. Yeah, here you go. Let me show you this. Here you go. So here's the silver price in US dollars, 1980,
Yep.
38.88.
Wow.
Didn't reclaim those levels until, 2011 and recently here. And again, this is, you can see the price of silver is higher than that right now. That's because the data stream ends at the end of September. So,
Right.
anyways, what movie starring Eddie Murphy was based on, and it's not really based on, it was kind of making fun of the Hunt brothers cornering the silver market in 1980. Loosely based on that whole
Loosely.
fiasco.
I'm not sure.
I hadn't seen it. I was reading about the silver market earlier today and somebody
Yeah.
wrote that. And I hope it's Eddie Murphy because I haven't actually seen the movie. So I could totally
Is
be
it
off on that.
I,
It's Trading Places.
Trading Places? Okay,
And my
interesting.
dad told me about this movie not too long ago. He was talking about it. He said you need to watch it because we're in finance. And I think they try to corner the orange juice futures or market.
Interesting. Orange juice and silver. Huh.
Yeah, well, so the actual story is about silver, but they thought it was funny, so they made a movie about it.
Yeah.
Called Trading Places, and I think it's about the orange juice futures market and them trying to like
Oh, I
corner the
gotcha.
market.
Yeah, so they changed it in the movie to be orange juice. That's
Yeah,
funny.
which is really funny that you can get like you can't get futures on orange juice, right? I know you can get it on oranges.
I think so.
I'm pretty sure you can get it on orange juice. That's really interesting.
I think so.
I need to make sure that I'm right. I don't want to say it's Eddie Murphy.
Oh, that's funny. I like
Yeah.
it.
Okay. Yeah. Here we go. I want to watch it now.
Yeah, now I'm gonna have to watch that as well. It'll be our homework between now and next week.
Yeah, it looks pretty funny.
That's
So
awesome. All right,
I
I'll
need
have
to
to
watch
watch it. Trading
it. It was
Places.
Eddie Murphy. I was right.
That's awesome. Awesome. Well, I like our new wrinkle of adding some trivia here. We'll have to do that next week as well.
I know.
Sounds
Today was a
good.
good week for trivia, though. There were a lot of trivia ready topics.
Yeah, definitely. So, well, that's all I have for this week. You got anything else? Any closing thoughts, Nick?
Nope, nope. I thought this was a fun one.
Sounds good. The best one we've ever done.
There you go.
All right. Thanks, Nick. Thanks, everybody.
Thanks, everyone.